Business development companies are facing increasing pressure from the Federal Reserve's pivot to rate cuts and potential fears about a recession or at least weakened economic conditions that could lead to a spike in non-accruals. You have Ares Capital Corporation CEO recently saying that he expects non-accruals and defaults to spike in the sector. And so for those reasons, some of these BDCs, which by regulation have to pay at least 90% of their taxable income as dividends, some of these BDCs are increasingly on dividend cut watch because of that. Now, BDCs probably don't suffer as much from dividend cuts as some of other sectors might just because of that fact that investors know that they're going to have high payout ratios and some of them may not be entirely sustainable, but still it's certainly a negative and will weigh on the valuations that some of these BDCs enjoy. And so in this video, I'm going to talk about two BDCs that I think are at risk of cutting their dividends, but actually are otherwise quite attractive at the moment. And so for me, I'm putting them on my watch list. One I actually recently sold opportunistically when it had a slight recovery and bought into another BDC that was higher quality that wasn't at risk of a dividend cut. But there's these two I'm going to talk about in this video, both on my watch list. And if and when they cut their dividends, I'm probably going to buy back in just because I think that they're quite attractive otherwise right now in the current environment. Before I get into what these BDCs are, though, if you could give this video a like, it'd greatly help in its distribution. Thank you very much. Okay, so the first one that I like, it's undervalued, but I think it may have to cut its dividend, is Oaktree Specialty Lending. Now, I've talked about it previously on this channel, and there are good reasons to like it. It's managed by Oaktree, which took over the fund, I believe, in 2018, has done a great job since. If you look at the underlying fundamentals, growing return on equity, growing net investment income per share, growing the dividend per share very significantly, improving the overall makeup of the portfolio. Oaktree is a storied credit investor. They have Howard Marks, who's a legend in the space, who's heading up operations there. There's a lot to like about that management team. And you get that management team for very cheap, both in terms of the stock price. It currently trades at a 10% discount to its net asset value, and it recently slashed its management fee from 1.5% to 1%, among the lowest in the externally managed BDC space. So you're getting this management fee for cheap, both in terms of the price of the assets that you're buying, as well as the management fee you're paying them. And so I think for that reason, it's very attractive. You also look at it, it's one of the least sensitive to interest rate cuts in the sector. So it's actually going to do okay during the current environment in terms of where its net investment income goes. It has a pretty solid balance sheet. It has one of the more defensively positioned investment portfolios with over 90% exposure to first lien senior secured loans, especially when you factor in its joint venture, which is almost entirely first lien senior secured loans into its aggregate portfolio makeup. And so there's a lot to like about OCSL. Its dividend yield is quite high at around 13%. So there's a lot to like. But why don't I own it? Well, simply due to the fact that its dividend coverage ratio of NII to dividend is of exactly 1 times. And so it is barely covering its dividend. Yes, this past quarter, which they haven't reported the results from yet, was the first one where its management fee cut from 1.5% to 1% is going to take effect. So that will be a tailwind. But last quarter, they did a fee waiver as well that helped prop up their dividend coverage ratio. And so there will be some offset there. Additionally, OCSL faces some debt refinancings in the not too distant future that will probably be a headwind to them unless interest rates drop tremendously between now and then. And so that's going to be a further pressure on their coverage ratio. Additionally, again, we don't know how the economy is going to perform. We don't know how their individual portfolio is going to perform. But if they have any more meaningful increase in non-accruals or write-offs, that's going to really hurt their net investment income as well. And the Fed just cut interest rates by 50 basis points during the third quarter. Yes, they're a little less sensitive than some, but they still are sensitive. And if the Fed continues to cut, that's going to be a lot of pressure. And so I think eventually, again, barring something crazy happening, I think OCSL is going to have to cut their dividend. And so it's that concern over the dividend cut and the uncertainty that provides and the potential headwind that will provide to shares that I'm out of the stock. I made a small 3% loss on it when I exited, but that's okay. It's not a big loss. I recycled it to another BDC that was actually down a good bit, well-covered dividend. It's Morgan Stanley Direct Lending. You can check it out. I'll probably make a video on it at some point in the future, but that's one I think is much more attractive on a risk-adjusted basis right now. So again, I think, that's my thought on OCSL. Now, the other one that I'm going to look at here, before I get into it, if you could please subscribe to my channel, help me to grow my audience. I greatly appreciate it. But it's SLR Investment Corporation, or ticker symbol SLRC. Now, this is a pretty unique BDC. It's very diversified. It's not like your standard just invest in sponsored first lien loans like a lot of these other ones are invested in. It's much more diversified with asset-backed investments, biotechnology loans, etc. But the bottom line with SLRC is it trades at about a 15% discount to its net asset value. So pretty compelling valuation there. Has an attractive dividend yield, well over 10%. It's covering its dividend by about 10% right now, which is pretty good, but it's not great. It's getting pretty narrow, but is among the least sensitive to Federal Reserve rate cuts, and that's because it's asset-based loans. Some of them are, and investments; those are pretty insensitive to rate cuts, and so and just the way its overall investment portfolio is structured is less sensitive to Fed rate cuts. So again, you need really aggressive Fed rate cuts for them to no longer be able to cover their dividend. But still, the coverage is tight. If they suffer any issues in their portfolio with an economic downturn or any other problems that cause non-accruals to rise, that could cause them to cut their dividend as well. And so, if I'm going to invest in a BDC right now with the Fed cutting rates, I want a big buffer covering the dividend. And so for that reason, I don't hold SLRC. But again, their balance sheet is pretty strong. Their dividend is very attractive. Their valuation is very cheap. Their portfolio is one of the most defensively positioned in the sector, again, because those asset-based investments, the biotech investments, and the first lien sponsored backed senior secured loans, those are all very defensive in nature and should do pretty well in a recession compared to some of their peers' portfolios. So again, I think SLRC is a very compelling opportunity too right now. Again, especially once we get through the cuts and of the Fed rate cuts, and especially if SLRC were to cut its dividend, increase its coverage buffer a bit, that might be a good time to buy in. So again, hopefully these are some good ideas to you. I think if you don't care about a near-term dividend, you're just a long-term value. You don't care about a near-term dividend cut, but you're just a long-term value investor. I think both of these are fine right now to buy. Or if you currently hold them, again, unless you panic about a cut, I wouldn't worry about selling them. I do think there are some more promising opportunities in the space, like I just shared. But again, for me, these are on my watch list. I'm going to buy them probably after a dividend cut if one comes. If not, that's fine. There are no called strikes in investing. I'll continue to deploy capital elsewhere. So again, hopefully this was helpful for you. If it was, give it a like, subscribe to my channel, and please let me know in the comment section below what you think of these two opportunities and any other BDCs you like right now. Thank you very much. See you next time.